Assalamu alaikum dear students. Today we will solve problem number 1 and 2 of chapter number 8, and these problems are taken from Financial Reporting and Analysis 12th edition by Mr. Charles Gibson. Let's start with the first problem. Here you can see we are given some data, and what we are required, we need to have calculate the net profit margin, return on assets, total asset turnover, and return on common equity for both years. Let's get start with the net profit margin. Net profit margin. As we all know, the formula to calculate the net profit margin is net income divided by net sales. So for 2009, the net income is 52,500 and our net sales are 50,000, and when we get divide the net sale with net income, we get the net profit margin, which is equal to 5%. And for 2008, our net income is 40,000 and our net sales are 10 lakh, and our net profit margin becomes 40%. Our second requirement is to calculate the return on assets. Return on assets. The formula to calculate the return on assets is net income divided by average total assets. So for 2009, our net income is same 52,500 and divided by average total assets, which are equal to 2,30,000. So our return on assets become 22.83%. And for 2008, our net income is 40,000 divided by average total assets, which are equal to 2 lakh. So our return on assets for 2008 becomes 20%. Third requirement is to calculate the total asset turnover. Total assets turnover. So the formula to calculate the total asset turnover is net sales divided by average total assets. So for 2009, our net sales are 10 lakh and 50,000 divided by average total assets, which are 2 lakh and 30,000. So our total asset turnover for 2009 becomes 4.57 times. And for 2009, our net sales are 10 lakh divided by average total assets, that are 2 lakh. So our total asset turnover becomes 5 times. Now we need to calculate the return on common equity, which is equal to net income divided by average common equity. So for 2009, our net income is 52,500 divided by average common equity, which is 1 lakh and 70,000. So our return on common equity for 2009 becomes 30.88%. And for 2008, our net income is 40,000 divided by average common equity, which is 1 lakh and 60,000. So our return on common equity for 2008 becomes 25%. It is all about the calculation of this problem, and then we need to comment on the results. So if you can see from for the net profit margin from 2008 to 2009, previously it was 4% and then now it is 5%. It means there is a little increase in the net profit margin, and also there is a slightly increase in return on assets, but there is a very little decrease in total asset turnover, while the return on common equity, there is a clearly increase in return on common equity. So we can conclude that if we look at the absolute data, we can also say that the net sales increased in the 2009, and this increase in sales is reflected in the net profit margin. So overall we can say that in 2009 the company's performance was better as compared to the previous year 2008. Let's we move towards the next problem. Here is the second problem of chapter number 8, but we need to calculate. Prepare an income statement in comparative form stating each item for both year as a percent of sale. It means we need to perform the vertical common size analysis. So for performing the vertical common size analysis, we need to divide the each item of income statement with the amount of sales. So here, if you look at the data, you can see that we are given with the sales, CGS, selling expense, general expense, and income tax expense. Let me first complete the income statement and calculate the net income. Let's we insert a row below, and here we put the net income. So for 2009, the net income will be sales, which are equal to 14 lakh minus 8 lakh 50,000 minus 2 lakh 5,000 minus 1 lakh and 40,000 minus the net income 82,000. So here the net income for 2009 is 1 lakh and 23,000, and for 2008 we will repeat the same process. Sales, which are 12 lakh minus the cost of goods sold 7 lakh 30,000 minus 2 lakh 40,000, which are selling expense, minus general expense, which are 1 lakh, minus income tax expense, which is 50,000. So we get the net income 80,000. Here we have completed the income statement. Let's we perform the vertical common size analysis. We need to divide the each item with the sales value. So we will get it divided sales with the sales. Uh, Let me do it first. All right. So here 100%, and then we will divide the CGS with the sales, and we get the percent of CGS with respect to sales, which is 60.7%, and we will do the same with selling expense, and we get the 14.6%, and then general expenses divided by sales, and we get the 10%, and then income tax 82,000 divided by net sales, and we get the 5.9%, and at the end we have the net income 1,23,000 divided by net sales, and we get the 8.8%. We will do the same process for the 2008 net sales divided by net sales of 2008. Obviously it will be 100%, and then CGS divided by sales of 2008 60.8%, and then selling expense 2,40,000 divided by sales of 2008, and we get the 20%, and for general expense 1 lakh divided by net sales, and it is 8.3%, and for the income tax 50,000 divided by 12 lakh, and it is 4.1%, 2%, and at the end net income 80,000 divided by net sales, and we get the 6.7%. These percentages are with respect to sales, and now we have to comment on the findings. As you can see that the net income for 2009 is 8.8% with respect to sale, which is greater than the net income percentage of 2008, and this increase is due to the a heavy decrease in selling expense. As you can see, in 2008 it was 20%, and now it is 14.6% with respect to sales. So this is the major reason that causes our net profit to get a rise. While if you see at the income tax expense, obviously it will be greater as compared to the 2008, because our operating income is greater than the 2008. And likewise, if you see at the general expense, although general expense a bit higher in 2009, but a major decrease in selling expense as compared to 2008 offset this increase in general expense. So overall, our net income is greater in 2009 as compared to 2009. So the firm is performing well in 2009 as compared to the previous year. Thank you so much.